Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. The portfolio is down again today, about over £2,000. At some point this morning I think it was about 39,000 or whatever it was. There we go, 59, sorry. And right now we're looking about 56,000. So it's over £2,000 down right now. Like I've always said to you guys, I'm not concerned, I'm not worried. If the stock market it basically fluctuates, one day is up, yesterday was up quite a bit, today is actually down, so that's a normal thing. I'm up about 4%, just about over £2,000, and that could disappear tomorrow. Okay, it does happen. To be honest with you, a lot of the companies that I own are right now in the green because of the FX impact. So if you look at this company, for example, Air Products and Chemicals, I'm up £700, over £700 because of the FX impact. Otherwise I would have been down about £500. So these things do happen. So there's no reason to panic. That doesn't mean it's the end of the world. There is a lot of basically negative sentiments out there, whether it is the UK pound going down, whether it's the US being in recession, UK being in recession, inflation going up, the Bank of England coming out a couple of days ago buying more bonds because they've kind of messed things up, the new conservative government, whatever. So there's a lot of things going on, but I'm, as always, positive about what's happening in the market. I'm looking for companies that I can actually own and add it to my portfolio or add to, and that's what we're going to do today. I'm gonna basically show you a company that I own in my portfolio that I'm really looking at, and again to see if I can actually buy more of this company, because it looks, the valuations now look attractive. So let's get started and look at that company. That company is Home Depot and is right now down 32%. Okay, and for basically year to date, 6 months is down about 12%, and when we look at just this month, about 6%, but last 5 days is up about 3.6%. But when you look at the year to date and you look at this company that was trading almost over $400, right now is trading $276. Okay, and one of the things I want to show you is the proxy statement from the company, and that's basically, I like to look at the proxy because it's a huge file, but it has a lot of really useful information. And if you're investing in a company for the first time, it's probably the best thing to look at. And the company basically talks about here basically what they're trying to do. So they said we aim to deliver shareholder value and grow our market share by providing best-in-class customer service through a seamless interconnected experience for our customers. And then they continue to talk about basically some of the things they do. So capital allocation is very important to them, and one of the things they're doing is this. Okay, they said first we intend to reinvest in our business to basically drive growth faster than the market, which I absolutely love. Obviously every company should be reinvesting that basically into the business first of all, because that's how you grow your business, right? We plan to continually invest in our business, targeting capital expenditure of approximately 2% of annual net sales on an ongoing basis. They also talk about basically we look to return excess cash to our shareholders through dividend and share repurchases, and that's, to me, this is the most important thing. Okay, yes, the company is growing, the business is growing. At the same time, any money that's left over, they are giving as a shareholder, basically to shareholders, through dividends and basically buying back their own shares. And 2021, this is what the company did: $151.2 billion in sales. That was $19 billion increase from 2020, and then $23 billion in terms of operating margins, profits, an increase of almost $5 billion from 2020, and that's return on capital, invested capital, was almost to 45% in comparison to 41% a year before. And when you look at in terms of the total shareholder returns in the last 5 years, you can see the orange is the Home Depot, and you can see it's actually being the S&P 500 and the retail index at the same time. So this company is actually generating a lot of cash and then giving it back to the shareholders as a form of dividend and so on. So that's the type of business I really want to invest in. And this is, if you don't know, the company is basically the one of the largest home improvement companies in the US. Unfortunately, they are only in the US, Canada and Mexico. They're not in European countries, which is a shame because it's a great company. But right now they're trading $276 per share. They have an EPS of $16 per share, and then market cap of $289 billion. $289 billion, and last year they actually made $151 billion that just one single year. That's a lot of money when you compare it to their market cap. The economy, basically, in terms of moat, for example, they have a wide moat, and they have a lower beta. I mean, it's 1, so that means they attract the market. If the market goes down 5%, they go down 5%. If they go up 5%, they basically goes up 5% as well. The PE is very interesting right now because PE is quite low, just 17. Average PE for the last 5 years, we're looking about 23. And then price to free cash flow, we're looking about almost a 26. But the sector is right now almost a 19. So it is below the sector, below the 500 average and the 5-year average, and the price to free below the price to free cash flow. So that is, to me, that means the stock probably is undervalued at the moment. They do have a nice dividend of 2.69%, payout ratio only 45%, which means they can increase that dividend anytime soon if they wanted to. They have 5-year growth rate of just 18%, which is really nice. Normally companies are looking about 6%, 7% is really nice. 18% is absolutely amazing. Dividend growth streak of non-stop increases over 13 years. They have been paying dividend longer, but they have actually increased every single year for the last 13 years. Dividend safety of 87%, which means it's definitely safe. And they have free cash flow of over almost closer to $11 billion right now in the bank. So that to me is a very healthy business that has a very generating basically a lot of cash and giving it out as a dividends, but they still have room to increase that dividends and so on. Profit margins just about 10, about 11, operating margins about 15.5, and return on invested capital is almost 40%, which is absolutely huge. Return in the last 10 years, we're looking about 18%. Current ratio above 1, so that means the company has enough cash, enough current assets to pay off the current liabilities in the next 12 months if anything happens to the business. Okay, and the next 5 years they're expecting about 15.7. Now I'm not sure if it's sustainable. 5 year, basically every single year, 15 and almost a 15% growth because of what's happening in the economy. Even if it goes down to 10%, that's still huge for this type of business. Okay, and Simply Wall Street is actually saying 29%, almost 29% undervalued at the moment. Fair value of $395 per share. Fair value according to Morningstar, and their fair value price is 267, and as you've seen it early, that's around where it is right now, 275, and then there is basically almost closer to that right now. Tip rank is about 30% upside and $363 per share. Yahoo Finance is almost the same, and according to Tip rank is actually a strong buy. Right, I'll tell you exactly what I'm going to do with this company in a bit, but let's have a look at the rest of the financials. So 2019, this company was trading, basically had a total revenue of $108 billion. Then it went up, and then it went up, and then it went up in 2022 to almost now $151 billion. Now, trailing 12 months, we're looking at $155 billion. So every single year, even during COVID time, it actually increased. COVID time, it actually went up a lot because a lot of people were at home and they just basically, people moved out their flats, whatever, or stayed in their little places and tried to maximize the basically by buying new stuff, doing it in the home nicely. Because remember, a lot of people were not doing anything else. They were not going out. So what do you end up doing? You spend a lot of money in the house and doing things up and fixing things and buying new furnitures and painting and all of that stuff. Obviously, everyone goes, especially in the US, everyone goes to Home Depot when it comes to that sort of a thing, right? Cost of that revenue is actually quite high, but gross profit, they take in quite a bit of money basically home. So from $155 billion, they taken about $52 billion of that. And the net income from 11 billion to now $16.8 billion of net income. EBITDA from 17 to now almost $26 billion in that. And of EBITDA, and then free cash flow from 11 almost to $10.5 billion to right now $10.8 billion. So there's been a little bit decline in the last 12 months. Okay, but that's absolutely fine. I mean, this type of company, they're generating a lot of cash. So over $10 billion is still a lot of money, although there's been a little bit decline just the last year and a bit. Okay, share basically outstanding, shares outstanding right now is still declining, which is absolutely perfect. And as you've seen on the proxy statement, they've actually already said I think they've actually recently came out, I think they are doing, is it 15 or 18 billion dollars of share buybacks. Again, they have authorized that already, and they have increased their dividend recently. So they are giving back a lot of money to their shareholders, which is one of the reasons I own this stock in my portfolio. And when you look at their from Sharia compliance side of things, as you can see here, is almost 100% when it comes to the business activity side of things, 100% Sharia compliant. Interest bearing about 15.4. Interest bearing securities is just 0.41. So great company, is undervalued at the moment. Just to be transparent, I'm going to show you exactly. I own 12.2 shares. I'm definitely right now looking at this company. If it goes down maybe another 3-4% in the next couple of weeks, which I will honestly, I don't think that's impossible to see basically this company under 265 or 60ish, okay, in the next few weeks. And that is basically what I will be adding to it 100% if that happens. The only reason I would not want to add right now, because I'm up quite a bit already, almost 13%, and a lot of that, like I said before, is FX impact. So I don't want to add to that yet, because I don't want to average up, especially in this kind of environment. And there's when you know, there's so many great companies that I own in my portfolio that are in the red right now. For that reason, I would rather add to the companies that are in the red than actually average up on a company that I own. But if, like I said, if it goes below 160, 165, 265, I'm definitely going to add to this company. There you have it. That's Home Depot, the company that, one of the companies that I own in my portfolio. It's down quite a bit this year, so we'll see how it goes. I'm going to keep an eye on it. Like I've said to you guys, I'm not going to add it today, but just to be transparent again, and I'm not showing off, I promise you, this is just to kind of show you I am not scared of what is happening. I've already, this week I actually haven't added the £250 that I normally add. That £3 actually was a dividend that came from, I think, with Seagro. I think today it came through, just today. This company actually paid me about £3, sorry, for some of the stocks that I owned before. Just to be actually transparent, let me quickly show you what that is. There you go, £3.08, and that was for 38 shares that I own at the time when the company went on ex-dividend. So yeah, I've added the 250, and I'm definitely gonna buy something today, because today it looks like everything is red, and definitely Friday I will be adding to some of the companies that I own also in my portfolio. And one of you guys asked me recently about, am I buying UK stocks, because I've talked about that in the last video, because of what's happening with the pound. Absolutely no. I'm just trying to, because there are companies that I own that in the UK actually were down quite a bit. I thought, you know what, let me take advantage of that and buy companies like RB, Rio Tinto, Unilever, and so on. So I still, if they go down more, I will be buying more of these companies, because as you can see, I'm in the red with, you know, majority of these companies. So why not add to them as well? Anyway, have a wonderful day. Assalamu Alaikum.